Your strategy is probably not your problem. Your entries are probably not your problem. Your chart reading is probably not your problem. Your emotions are your problem. And I do not mean that in a vague motivational sense. I mean it in a specific, measurable, financially quantifiable sense. Right now, today, your emotional reactions to market movement are taking money directly out of your account that your correct analysis already earned. And in this video, I'm going to show you exactly how that is happening, exactly why your brain allows it, and the exact behavioral structure that stops it. In the next 18 minutes, I'm going to walk you through 3 specific ways emotional trading destroys profits. Not your overall trading, not your long-term trajectory, but the specific profits that your correct analysis generates in individual sessions. Each one has a real trader story, a clear psychological explanation, and a specific, immediately applicable fix. By the end of this video, you will understand the precise mechanism through which emotion converts correct trading decisions into incorrect financial outcomes, and you will have a behavioral structure that interrupts that mechanism starting in your very next session. Let's get into it. Let me tell you about Ethan. Ethan is 28 and has been trading live for about 13 months. He has something that many traders spend years trying to develop, a genuinely solid read on market structure. His entries are clean. His planned setups, when reviewed objectively after sessions, show a win rate of around 63% across the last 3 months. That is a strong win rate. A system with 63% wins and a 1-to-2 risk-to-reward ratio should be producing consistent, meaningful account growth. Ethan's account has grown by about 4% over those 3 months. Not 4% per month, 4% total across 3 months. The math does not add up. And when I sat with Ethan and went through his journal in detail, the reason was immediately clear. His achieved risk-to-reward ratio was not 1-to-2, it was 1-to-0.8. He was risking $1 to make 80 cents on average. Not because his targets were wrong, because he was exiting his winning trades at an average of 40% before his planned target. On his winning trades, Ethan was capturing less than half of the profit they were capable of producing. His 63% win rate, which should have been generating substantial profit, was being systematically undercut by exits driven not by his trading plan, but by fear. Fear that the profit would disappear, fear that the trade would reverse, fear that holding to the target was greedy or naive. That fear, expressed trade by trade across 3 months, had converted what should have been a growing account into a nearly flat one. Here is what makes Ethan's situation particularly revealing. He knew his targets were right when he set them. Before each session, in a calm, analytical state, he identified his targets based on legitimate market structure, levels where profit-taking was logical and well supported. The fear that made him exit early was not based on any new information about the market. It was based entirely on the discomfort of watching unrealized profit fluctuate while he held. The market was not changing his analysis between entry and target. Fear was changing his behavior before the analysis could play out. Think about your own winning trades in the last month. What percentage of them reached your original planned target? Not approximately, specifically. If you have a journal, calculate this number this week. For most traders who have never calculated it, the result is a significant surprise. The gap between planned target achievement and actual target achievement is where a substantial portion of every trader's missing monthly profit lives. Why it happens psychologically. The fear-driven early exit is produced by what behavioral economists call the disposition effect, one of the most extensively documented phenomena in financial decision-making. The disposition effect describes the tendency to exit winning positions too early and hold losing positions too long, the exact opposite of what profitable trading requires. It occurs because the moment a trade moves in your favor, your brain begins treating the unrealized profit as something it already possesses, something that can be taken away. The prospect of losing something you already have activates a threat response that is neurologically similar to the response to physical danger. Your amygdala, the brain's threat detection center, fires. Cortisol rises. Your attention narrows. And the specific thought that arrives, I should take this profit before it disappears, feels like prudent caution rather than fear-driven, suboptimal decision-making. But it is fear-driven, suboptimal decision-making. Because the trade has not reached the level where your analysis says profit-taking is logical, the exit is driven by your nervous system's response to the perceived risk of losing unrealized gains, not by any new information from the market that would justify changing the plan. There is also something called anticipatory loss aversion. Your brain does not wait for a loss to occur before generating the aversion response. It generates the response in anticipation of potential loss, which means the fear that drives early exits arrives before anything has actually gone wrong. You are experiencing the emotional response to a loss that has not yet happened and may never happen, and that emotional response is overriding the rational plan made before the fear arrived. The exact fix. The hard target order protocol. Implemented at entry on every single trade. Here is exactly how it works. The moment you enter a trade, before you watch it move a single pip in any direction, you place a hard limit order at your planned target price. Not a mental note, not a reminder, an actual order sitting in the market that executes automatically when price reaches your target. This order is placed before the emotional environment of the live trade activates. It is placed by the calm, analytical version of you who set the target correctly in the first place, and it executes without requiring any decision from the fearful, profit-protecting version of you who will be managing the trade 10 minutes later. Additionally, once the hard order is placed, you close the chart. You do not watch the trade move pip by pip. You set a timer for 30 minutes. When it goes off, you check the trade for 60 seconds, confirm it is running, confirm nothing structurally significant has changed in the market, then close the chart again. This removes the real-time stimulation that activates the fear response in the first place. You cannot experience anticipatory loss aversion about a trade you are not watching tick by tick. Ethan implemented both components on every trade for 30 days. His achieved risk-to-reward ratio went from 1 to 0.8 to 1 to 1.85, almost exactly what his plan specified. His account, which had grown 4% in the previous 3 months, grew 11% in the single month he ran the protocol. Same entries, same market, same pairs. Different hold discipline produced by removing the opportunity for fear to make the exit decision. Place a hard target order at entry before fear activates. Close the chart after entry and check only every 30 minutes. Fear cannot exit a trade that has already been given a hard mechanical exit instruction. The calm version of you who sets the target correctly must make the exit decision, not the fearful version who watches every tick. Meet Vanessa. Vanessa is 31 and has been trading for about 18 months. She has solid risk management on paper. Her written trading plan specifies stop-loss placement at logical market levels. Her maximum risk per trade is 1% of account. She understands and endorses every aspect of her risk management framework when discussing it in a calm, reflective state. In live sessions, she has one specific habit that systematically violates her risk framework in ways she does not fully recognize as violations while they are happening. When a trade moves against her, when it gets within 10 pips of her stop loss, she moves the stop. Not dramatically, usually another 15 to 20 pips. She tells herself she is giving the trade more room to develop. She tells herself the stop was placed slightly too tight and that a more reasonable placement would be further out. These explanations feel analytical. They feel like sophisticated trade management rather than emotional avoidance of a planned loss. The financial impact of this habit across 18 months has been substantial. In a month with 8 losing trades, Vanessa's average planned loss per trade is $35. Her average actual loss per trade, after stop moving, is $67. Every planned loss she takes is on average 91% larger than her risk management framework specified. Her 1% risk rule is not actually a 1% risk rule in practice. It is a variable risk rule that expands under the specific emotional condition of not wanting to be wrong. Here is the key insight about stop moving that most traders miss. It does not feel like greed when you are doing it. It feels like patience. It feels like giving the trade a fair chance. It feels like sophisticated flexibility rather than rigid rule following. Greed in trading rarely announces itself as greed. It arrives wearing the costume of reasonable judgment, and the disguise is convincing enough to fool intelligent traders repeatedly. The greed element here is not the greed for more profit. It is the greed to avoid a confirmed loss, the unwillingness to accept that a planned loss has now arrived and must be taken. And that specific form of greed, loss avoidance expressed as stop moving, is one of the most expensive habits in retail trading because it converts controlled, planned, mathematically manageable losses into larger, more damaging ones. When was the last time you moved your stop loss further from your entry on a trade that was moving against you? Not moved it closer to protect profit. That is a different and often legitimate practice. Moved it further away because you did not want to close at your planned level. If you can recall that experience, what did the decision feel like in the moment? Did it feel like greed, or did it feel like something more reasonable? Why it happens psychologically. Moving stop losses on losing trades is driven by the same loss aversion that drives early exits on winning trades, but operating in the opposite direction. The disposition effect applies here too. While it drives you to exit winners too early to protect unrealized gains, it drives you to hold losers too long to avoid confirming unrealized losses. Both behaviors are the same underlying mechanism, expressing itself in two different ways. There is also something called the pain of regret in advance. Closing a trade at your planned stop loss is a definitive, irreversible action. The moment you click close, the loss is real and permanent. Your brain generates a specific anticipatory response to that irreversibility, imagining the regret you will feel if the trade immediately recovers after you close it. That anticipated regret is often more emotionally intense than the actual loss, and it is powerful enough to drive the stop-moving decision that keeps the loss theoretical rather than real for a few more minutes or hours. The stop-moving rationalization, I am just giving it more room, is produced by a cognitive process called motivated reasoning. When you want a particular outcome, not closing at a loss, your brain actively constructs analytical-sounding justifications for the behavior that produces it. The justification sounds like trading analysis. It is actually emotional avoidance dressed in analytical language. And because it sounds like analysis, it bypasses the critical thinking that would otherwise reject it. The exact fix. The pre-entry stop commitment protocol. 3 steps. Completed before every entry in the following specific order. Step 1. Identify your stop-loss level based on market structure, the level where your trade idea is definitively invalidated. Not approximately, exactly. Write it in your journal before entry. Step 2. Write this sentence below the stop level. If price reaches this level, my analysis was wrong and I close immediately. I will not move this stop further from entry for any reason, regardless of what I am thinking or feeling when it approaches. Step 3. Place the stop as a hard order in your platform immediately after entry, before you have watched the trade move at all. The order is placed. The commitment is made. Your future, emotionally activated self is now bound by a decision made by your current, calm, analytical self. The written sentence in Step 2 is not just a reminder. It is a pre-commitment device that creates a specific cognitive obstacle between the stop-moving impulse and the stop-moving action. When your hand moves toward the stop adjustment, the written sentence is there, in your own handwriting, representing the commitment you made when your judgment was clear. That obstacle does not always stop the impulse, but it creates a moment of pause that gives the rational mind a chance to reassert itself before the emotional decision is executed. Vanessa used this protocol. Her average actual loss moved from $67 to $41 per trade in the first month of implementation, still slightly above her $35 planned average, but dramatically closer to it than her 18-month habit had produced. Her total monthly loss figure that month was the lowest of her trading career, despite having a similar number of losing trades. The losses were smaller, not because fewer things went wrong, but because the losses that occurred were closer to their planned size. The protocol reduced the average damage of each loss without reducing the number of losses. Write your stop-loss commitment before entry. I will not move this stop further from entry for any reason. Place the hard order immediately. The pre-commitment creates a cognitive obstacle between the impulse and the action, giving your rational mind a moment to reassert itself before greed, dressed as patience, executes the stop move. Let me tell you about Adam. Adam is 30 and has been trading for about 22 months. He is more disciplined than most traders at his experience level. His plan is solid. His execution on most days is clean. His results are positive overall, not dramatically, but consistently in the right direction on most months. But Adam has a specific vulnerability that he has identified but not yet solved. On days when valid setups are scarce, when he has been watching the market for 90 minutes or 2 hours and nothing that meets his criteria has appeared, something shifts in him. A restlessness begins, a low-grade frustration with the market for not cooperating, a feeling of wasted time that demands compensation through action. And in that state, his criteria begin to soften. Not dramatically, not in ways that feel like violations while they are happening. A setup that is 70% of his criteria feels like 90%. A pair he does not normally trade suddenly looks interesting. An entry timing that is slightly early feels justified by the overall direction. The frustration generates a hunger for action that his brain satisfies by finding reasons to trade. Reasons that feel like analysis but are actually rationalized impatience. The trades that come from this state are not good trades. Adam knows this from his journal. His slow session frustration trades have a win rate of 29%. His calm session valid trades have a win rate of 61%. That is a 32 percentage point gap. The frustration trades are not breaking his account month by month, but they are consistently giving back a meaningful portion of what his clean execution produces. They are the hidden tax that frustration pays to the market on his behalf every time a session runs slow. Here is what makes the frustration trade particularly insidious. The frustration that generates it is completely understandable. You have set aside time to trade. You have done your preparation. You are at your platform, ready, focused, and the market is simply not offering what you need. Of course, frustration builds. Of course, the desire to do something productive with the time creates pressure. These are normal human responses to a genuinely frustrating experience. But the market does not produce opportunities on a schedule that accommodates your session plan. It produces them when conditions align. And the frequency with which conditions align with your criteria has no relationship to how long you have been waiting or how frustrated you feel about the wait. The frustration is real. The trades it generates are not real opportunities. They are manufactured ones, created by your emotional state rather than by the market. Have you had sessions where valid setups never appeared and you traded anyway? Have you looked back at those trades and struggled to articulate clearly why you entered them in terms of your actual criteria? If yes, those were frustration trades. And the financial damage they produce across a month of trading is almost always larger than it feels trade by trade. Why it happens psychologically. Frustration in a trading context activates what neuroscientists call the action imperative, a drive state generated by the limbic system when goal progress is blocked. When your goal is to find valid trading setups and the market is not providing them, the blocking of that goal creates escalating arousal that drives behavior oriented toward relieving the frustration through action. Any action. Not necessarily appropriate action, just action that reduces the uncomfortable feeling of blocked goal pursuit. This is the same mechanism that drives people to tap their foot impatiently, to pace when waiting for news, or to make phone calls they know are too early, just to feel like they are doing something. In trading, the action the frustrated brain reaches for is a trade, because taking a trade is the closest available analog to accomplishing the trading goal that frustration is blocking. There is also something called temporal discounting under frustration. When you are frustrated, the future consequences of your decisions, lower win rates, eroded profits, damaged session results, are discounted relative to the immediate relief of taking action. The relief of clicking the entry button feels more important than the statistical reality of what frustration trades produce. That is not a rational calculation. It is what frustration does to your decision-making timeline. The exact fix. The frustration exit rule. Implemented before every session as a written commitment in your journal. Here is the exact structure. Before opening your platform, write a number at the top of your journal page, your session patience limit in minutes. This is the maximum time you will remain at the platform in a single stretch without a valid setup appearing before triggering the frustration exit rule. For most traders, this is between 60 and 90 minutes. Write it. Commit to it. When you reach that time limit without a valid setup, you do not keep looking. You close the platform. You leave your trading space. You spend at least 15 minutes in a completely non-trading environment, outside, in a different room, engaged in any activity that shifts your physical and mental state. Then you return and run a 2-question check before reopening the platform. Question 1. Am I returning to trade because conditions may have changed, or because I still feel the urgency from the frustration of the slow period? Question 2. If I return and still find no valid setup in the next 30 minutes, am I genuinely prepared to close the platform again without trading? If the honest answer to question 1 includes any component of frustration urgency, do not return yet. Wait longer. Because the frustration state, not the market, is what generates the session's most expensive trades. And the frustration state does not fully reset in 15 minutes for many traders. It needs genuine deactivation, not just a brief pause before returning to the same screen with the same frustrated energy, looking for the same elusive setup. Adam implemented the frustration exit rule with a 75-minute patience limit. In his first month, he triggered the rule 6 times. In 4 of those 6 sessions, he returned after the break and either found a valid setup that he traded cleanly or found nothing and closed the session without trading. In 2 of the 6, he recognized during the 2-question check that his frustration had not fully cleared and extended the break. His frustration trade count that month dropped from its typical range of 8 to 10 per month to 2. His overall monthly result was his best in 22 months of trading, produced not by better setups or improved analysis, but by simply removing the category of trades that had been functioning as a consistent monthly tax on his profits. Implement the session patience limit and frustration exit rule before every session. When you reach your limit without a valid setup, close the platform and deactivate before returning. The 2-question check ensures you return to trade because conditions warrant it, not because frustration is still driving the urgency. Frustration trades are a tax. The patience limit is how you stop paying it. 3 specific ways emotional trading destroys the profits your correct analysis generates. 3 precise behavioral structures that stop each one. Emotional Destroyer 1. Fear converts winning trades into partial results. The disposition effect drives you to exit winners early to protect unrealized gains, converting trades that should produce 1 to 2 risk to reward into trades that produce 1 to 0.8. The fix is the hard target order placed at entry before fear activates, combined with chart closure and 30-minute check intervals that remove the real-time stimulation that generates fear in the first place. Ethan's account growth went from 4% across 3 months to 11% in a single month with this one structural change. Emotional Destroyer 2. Greed converts controlled losses into account-damaging ones. The motivated reasoning that disguises loss avoidance as sophisticated trade management drives stop moving that systematically increases actual losses beyond planned levels. The fix is the pre-entry stop commitment. Written, specific, placed as a hard order immediately at entry. The written commitment creates a cognitive obstacle that gives your rational mind a moment to reassert itself before greed, dressed as patience, moves the stop. Vanessa's average actual loss dropped from $67 to $41 in her first implementation month. Emotional Destroyer 3. Frustration creates trades that have no business being in your account. The action imperative generated by blocked goal pursuit drives below criteria entries that produce win rates of 29% versus 61% for clean setups. The fix is the session patience limit and frustration exit rule, a specific time boundary after which you close the platform, deactivate genuinely, and pass the two-question check before returning. Adam's frustration trade count dropped from 8 to 10 per month to 2, and his best trading month in 22 months followed. Your strategy is not destroying your profits. Your emotions are. And now you have 3 specific structural fixes that take the most expensive emotional decisions out of your hands: mechanically, behaviorally, and permanently. Use them starting in your next session. If this video gave you a precise, actionable understanding of exactly how emotion is costing you money, subscribe right now and hit the bell. Every week, I post content at exactly this depth. No vague mindset advice, no recycled tips. Specific, behavioral, psychology-based work that produces real results. And in the next video, I am going to walk you through the complete trading plan framework, every section, every question, every answer that gives all 3 of today's fixes a structured home. That plan is the foundation that makes everything sustainable. Subscribe. Do not miss it. See you there.